Hi guys, welcome to today's session. I would love it if somebody in the audience could tell me whether you can see me and hear me. I've disabled strategy quant today, so hopefully we don't have the same issue as yesterday where the chat wasn't loading and I think I was frozen for a period of time, but I'm not 100% sure. So I've tried to free up some of my PC power. Perfect. Thank you guys. Document just published. Welcome. Appreciate you saying you can hear me and see me. Jason Bolt, afternoon. Yes, we can. Appreciate that, dude. Welcome both to the session. BQPN. Let's jump straight in. Let's take a look at BQPN because you did say this yesterday, right? Did we look at this before? I'm sure we've looked at this before. I can't remember when it was though. Moving higher today, nice. For me, the market today has just been awful. I would say even for the past sort of week or so, I've not had a fun time. I keep getting chopped up at the minute. We haven't looked at it. I thought we had. I think it's because I recognize your username. And I also recognize this as well. Maybe I've looked at it sort of on the back end because I do sit here quite often just going through random strategies. I'm also stood up today. I'm leaning on my desk. I completely forgot for about 3 months that I've got a standing desk. And so I do lean on it. So if it's a little bit shaky, let me know and I'll sit down or I'll stop leaning on it. Canis Lupus, I've been stuck in stagnation for 5 weeks. Yeah, stagnation is fine. It's those horrible, nasty drawdowns that are the worst. But I think I wrote a post about stagnation, I don't know, maybe a couple of months ago, and about how it should be embraced. Like there's no rush to break out of it because especially if you're running a multi-strat, the stagnation period is kind of where your strategies aren't all aligning. But if they all have a positive expectancy, generally there will be times where they all align, which is probably where you'll make the majority of your return. Then you'll have the period of time where you're in stagnation, where they're kind of working together. And there's a very, very low chance of having like a really poor period where all of your strategies fail or they all go through a period of drawdown at the same time. You can minimize that by doing, cross-referencing your correlation on strategies and stuff when you're building your portfolios and building your multi-strats. But that's why I embrace stagnation, because I'm kind of like, you're either in a growth phase or a stagnation period. The drawdown is kind of where I start analyzing things and being like, okay, well, something's kind of gone amiss here, so I need to figure out what it is. Have I got too many strategies that are positively or negatively correlated with one another, and therefore, the drawdown is amplified because all of the strategies are losing at the same time. Any advice for DALY? I'll take a look at DALY in a moment. Hey, how do you get strategy ideas? Welcome to the session. I've been a trader for 7 years, so I have a lot of ideas anyway. But I'm quite a curious person. So if I think of something, how are we doing, Clive? Hope you're all good, my friend. If I think of an idea, I will go out and do a bit of recon on it. Half of the time, it doesn't work long term. This is the problem that I have with, not to get too off topic because you're asking how I get strategy ideas. Reading books online, own curiosity, just so many different ways. And then I'll spend a period of time testing the idea out. I'll try and build the logic myself on like a chart first. If it's like technical based or time based, I'll try and build an idea on a chart, get a good example of what I'm trying to see and how it would look. And then I'll build the strategy and then actually run tests on it. Half the time, in fact, I'd say 90% of the time, the idea ends up being a dud and not working. And I was going to say, this is my argument with somebody's asked for subtitles. I'm not sure if you can put subtitles on StreamYard. We do have Spanish sessions, however, that are 100% dedicated to those who speak Espanol. Whereas in here, my Spanish is very, very, very rusty, and I won't be able to run a Spanish session. But yeah, I don't think I can enable subtitles, or at least show subtitles. And then because it's a live session, generally YouTube won't do it either until maybe after the fact. So I apologize for that. But going back to my point is, this is why I have an issue with educators who will talk so much about their system, and it'll be like, this is the only way you should trade. All you need is one time frame, one asset, one whatever it is. And you're like, well, that's great while it works, but then what happens when it doesn't work? Which I can tell you for the majority of systems is, they have a shelf life. I've tested a lot of strategies that I found on Twitter or Instagram. I'll see somebody who posts about a specific strategy, and when it's simple, it's very easy to build and mimic. So it'll be like, oh, I do this for 10 minutes a day. That's automatically when somebody's full of shit. But I'll go away, I'll build it, I'll test it, and I'll test it over a long period of time, right? And you can just see it just collapses and falls apart. But it has good periods, and generally those good periods kind of align with when the educator or the group ramp up their marketing. That's what I've noticed anyway. So yeah, the main thing is, if you're anything like me and you're building a multi-strat, the main thing is to build hundreds, if not thousands, of strategies on random ideas. It doesn't have to be anything technical or indicator related. It can be something to do with time or price points or lunar cycles. It can be whatever you want, as long as it's unique and it doesn't have too much complex logic. It's likely going to hold up over a longer period of time. CSM, hello, how are you today? I am very, very well, my friend. Welcome to the session. I'm a bit busy today. I come mostly to say hello and hope you guys are having a good time. I appreciate that, dude. Appreciate that big time. I hope you get a little bit unbusier later today. But thank you for dropping in and coming to say hi. I appreciate that. Good. I run 4 strategies and planning to add more. Yeah, so that's a great start. Every strategy you add should be part, like, there should be a reason to why you add it to the portfolio. And the reason why I say that is because I went through a period of time where I was adding loads of strategies kind of willy-nilly with no real approach. And we will go to BQPN in a moment. I'm just answering these questions. I was adding these strategies willy-nilly to the portfolio, and it was great. And I was slightly lucky in terms of it benefited the portfolio. But then what happened was I got to a point where on all of my testing periods, I had a couple of years out of the whole sample that were just really poor. And I realized that I was very heavy-sided. There was no like real correlation issues, but I was clearly biased to a specific market condition. So what I started to do is add more mean reversion strategies in. So when the market isn't breaking out or trending, at least I'm able to catch, some moves that are, more of kind of like a pullback or a ranging market instead of just waiting for the breakouts. And kind of the idea was I need to diversify the portfolio within so that it can trade multiple market conditions. So moving forward, like if you have a goal of saying increasing your strategies from 4 to 10, try and work out like, okay, well, out of those 10 strategies, I want 2 or 3 to kind of do this job and to perform well during this market environment. How are we doing, Tal? I always appreciate the hey handsome when that comes in the in the chat. Add them with purpose and you'll see a massive rise in efficiency in your portfolio. Whereas if you're adding the same strategy on, similar assets, all you're doing is pretty much increasing your exposure to the same thing again and again and again. So yeah, just any idea that you hear or you read or you see, just test it out. I have one strategy. I've spoken about it a lot in these sessions, so I apologize for the guys who already know this. I'm also changing my light because it looks darker than it is. No. Yeah. One of my strategies was born out of a conversation that I had with one of my friends. So one of my friends, I was on a call with him and we were just talking about trading, and he said to me, it was a throwaway comment, and he said, "Have you ever noticed that when the ES or the S&P closes red on a Friday, it always opens bullish and has a green day on a Monday?" And what interested me was not the fact that he'd given me this idea, but he said it always closes green. So obviously I was like, okay, well, what I'm going to do is I'm going to build that strategy and I'm going to prove you wrong, right? You should never say always does this. So we were on the call. It took me about 10 minutes to put the strategy together. I built it and then I started testing it. And I was like, oh, okay, actually, and you know, there's something in that. It doesn't, of course, it doesn't always close green on a Monday, but I was like, there's definitely a strategy there. So I ended up building it, and I still run it to this day. The only improvement that I've made to that strategy is adding a spread filter in, so that because it enters on the Sunday open, so on the cash open, I monitor the spread. So I don't want to be getting into a position that, you know, where the spread blows out because something's happened over the weekend, and, you know, spread might be 2 times the size of my stop or my target. And so that's the only sort of improvement that I've made. And that's not because the strategy blew up on a trade, but it's because I realized that that was kind of a liability or a point of exposure on that system. And so I made that, well, I actually made that adjustment for every strategy, but it's super random, right? And it came from a conversation with a friend. It wasn't me sitting down and planning a strategy or putting a plan together of how to improve the portfolio. It was nothing like that. It was just simply my friend said something to me, and it was the wording that he used. And I was like, okay, I'm going to prove you wrong. But I actually ended up proving him semi-right. And then, you know, I've made money from that conversation. So just keep your eyes and ears open at all times. And one of the things I would say with building strategies is that oftentimes the things that you think are guaranteed to work don't work, and the things that you think aren't going to work generally do. So again, I have a few mean reversion systems that work with the RSI, and it works great. You know, but if you were to go on Twitter or YouTube, you know, and start reading stuff from smart money concepts people, which God, don't even get me started on smart money concepts. They'd say RSI is retail trader logic, and you know, it's not the algorithm, yada yada yada, but it works, and it works over a long horizon if you use it correctly. So yeah, don't let your own bias judge what strategies you build or don't build. Do you always close trades before market closes to prevent gaps? No. So sometimes I have a lot of strategies that do. My more frequent ones do. So I have a strategy that pretty much trades most days on dollar yen. That does close before the market closes. It's not necessarily to prevent gaps. It just helps with the efficiency of the strategy. But then I have other systems that run on higher time frames that I need to be in for multiple days. So I'm in a NASDAQ long, and I've been in it since Sunday. I'm up slightly on it, not a lot. I'm up like $9 or $10 with a target of like 200, right? So I'm barely up anything, but I will likely be in that trade for a couple of weeks, so I can't close that out. The only time I would close it if the swaps start ramping up. But the thing is, with NASDAQ, you get paid dividends anyway, so you have to kind of take away the dividends from the swap fees to get an accurate representation of the cost of holding that position. But yeah, all depends on the trades. I would prefer strategies to close at the end of the day, or at least at the end of the week, just to minimize that impact. But I do have some strategies that don't. Quantum Go said, to your pattern topic is true. I'm testing for stocks, for example, Apple buy, May, sell, September. This is Rapalas from Discord. How are we doing, Rapalas? Quantum Ghost, I like that name. I'm not sure what part of the pattern topic you were on about. Tommy 5000, hey sexy. Now who's this? Is that Rob? I can't remember who it is. I like all these compliments though. Maybe it's the lighting. Maybe it's my lightsaber. Makes me look good. Seasonality. Yeah. So seasonality is a massive one, right? And it's a great one to look at. Like, I live my life. I was thinking about this when I was out for a walk earlier. I live my life with averages in mind all the time. So I always look at like worst case, best case, and the average, and I work off the averages. And so like when you're looking at something that's some like seasonality strategies, you can build things that, or not even necessarily you can build things, you can know things are more likely to happen just based on the time of year or what's going on, you know, this. And again, I have some strategies that I block out certain months of trading. I have some that only trade certain months, certain days, certain times. Like there's so much that goes into seasonality. It's SPWR. I thought it was you, Rob. I always get confused because of the different names. But anyway, got off track a little bit. Let's go back to BQPN. I'm going to take a look at the amount of trades that you have. It's 1,843. Wow. Okay, and that's in 6 months. Yeah, 6 months. So I mean, fantastic start. I mean, there's kind of like 2 periods of your curve. Let me load up my pen. I say I'm drinking sparkling water at the minute, and it's like it's so gassy. Like it doesn't go down; it just sits in my throat. So like here to here, and then here to here looks very similar. But then I struggle to understand why this period looks so different. Maybe it's just market conditions, but it's slightly. I wouldn't say concerning, but it sticks out to me that something was going on here that you need to be aware of. I don't know whether it's you were pyramiding into trades and you started to take on a little bit more exposure. I don't know if it could have just been market conditions, huge losing trades. Okay, so are those trades that you've pyramided into and got into, you know, with more size? I'm presuming it's not a martingale strategy, purely because this doesn't look like martingale here. This does, and that does, but this doesn't. But yeah, just be okay. So it is a martingale. I guess that kind of does make more sense. We'll take a look at your loss aversion. Even this doesn't look like martingale. Some martingale. Yeah, this trade. So this is of concern. Oh, why is that so thick? Is that better? Yeah. So that one trade is of concern, right? Because we have to ask ourselves why that happened. I guess these are as well, because if we take a look at your average MAE, or maximum adverse excursion, it's probably around this level, right? So we're looking at, it's probably the average here, but then there's a massive gap from your average. Again, going back to what I was saying about living my lives in averages, there's a massive gap between your average and your maximum excursion, which isn't a great sign for allocators, because they're going to say, well, you might carry on with trades like this for the next year, but they know that this is a possibility. So you might be trading for another year and then have a massive drawdown again. And that's the only concern with this. Let me load you up on Darwinex, because we give you a score for this. Darwinex. Oh, Christ. No, Rob, martingale isn't trading both sides. Martingale is where you increase your size on losing positions. So the best example of martingale I can give you is if you're playing roulette, for example, and you're betting black or white. Say you start out with £1, so you put £1 down on black, you lose, you then go to, okay, £2 on black. You bet the same thing again and again. You lose that £2, so then you bet £4, then you bet £8, then you bet £16. It's the same with trading. So like, you know, the price might be dropping of, I don't know, an asset, let's just say the Nasdaq, and you buy 1 lot, then you buy 2 lots, then you buy 4 lots, same sort of thing. So what happens is it's very, very stable for a long period of time, because generally you take small wins and have either no stop, well, usually no stop. And then when you get caught up into a bad move and the market goes against you big time, you start adding size, but the market keeps going against you. So your drawdowns are thick and sharp. Huge overdrawn balance over the weekend. Okay. But eventually we stop loss out. Okay. That makes sense. Should have said grid. Okay. Yeah. But yeah, martingale, it's not necessarily just trading both sides. Martingale is, adding size to the one size. So yeah, you can see your loss aversion scores 2.1, and that is probably the three of these trades. Three of those trades, maybe this one as well, that really don't help you just because of the disparity between what I would say is your average is probably somewhere up there and the disparity between these candles. That can really hurt you moving forward. Nothing to be like overly concerned about yet, but I think the K-base says it best. Loss aversion, Darwinex. Let me talk about it in the K-base. What does it tell you? Yes, loss aversion evaluates whether a trading strategy exhibits symmetric behavior independently of whether a position is winning or losing. In economics and decision theory, loss aversion refers to people's demonstrated tendency to prefer to avoid monetary losses rather than acquiring equivalent gains. Darwinex considers this behavioral bias extremely dangerous, especially if it's combined with significant levels of leverage. So let's do my old trick. Let's whack this into let's whack it into ChatGPT. In fact, I'm going to not Claude. Oh no, we'll use ChatGPT. I've migrated a lot of my Darwinex stuff over to whatchamacallit, Gemini, because as you can see, the missus uses this one. I use it for my IMC stuff, which I'll explain about in a minute. Is like game changing for me. Explain this to me like I'm 5. I am a trader, however. So explain with the. Oh, no, it's just good. Yeah. So what I've been doing with my IMC is I've been reading the books, highlighting all the key points, and then I've been scanning it with my phone. So if you go onto your camera on your phone, you can scan text now, or at least with iPhones anyway. You can scan text and like copy and paste it. So I open the book, I scan the text, I paste it into a Google Doc. Then I upload the Google Doc to this conversation or one of the conversations in here in the study assistant notes. I upload it into there, and then I voice call the ChatGPT. So let me see if I'll do it. I'll do it in real time. I voice call it, and then I ask it to ask me some questions. So we got IMC, CFA, study assistant notes. It's quite clogged with information, but this is for anybody studying. So like this is a real issue that I found with starting the IMC is I've forgotten how to read and I've forgotten how to learn. I mean, I'm getting way off topic here, and I apologize for going off topic whilst looking at BQPN. That's why I don't do well in these strategy development sessions anymore, because I just end up rambling. But I really forgot how to learn this because we're so reliant on AI these days. But with ChatGPT, you click this button. Oh, why is it not working? Let me close it down. I'll reopen it. How we doing? Hope you're all good. IMC study notes. Oh my life. Here we go. It's not showing, but I think it's connecting. Ah, there we go. Hello.
Yep. Hey there. I can hear you loud and clear now. Sounds like we're all set. Let me know what you need.
Can you explain to me what a multilateral trading facility is?
Absolutely. So A multilateral trading facility, often just called an MTF, is basically like a trading menu that's not a traditional stock exchange, but it lets you buy and sell.
Tell me that isn't revolutionary. Like, I know they put blockers in place these days with exams and schools so that, you know, kids can't use AI to pass exams, but that's the next best thing, right? You basically got your own personalized study assistant or somebody who tests you. Like that person in ChatGPT tests me every day. So I'm just uploading everything that I read and doing it. But again, the point here is, I mean, again, I'm going off topic, but try and think outside the box with everything that you do. Like, if you, for example, if you're struggling with trading psychology or patterns in charts, take screenshots of all your charts. If you're a discretionary trader, send it to ChatGPT. Open up the voice conversation and ask it any questions. It knows everything that you've sent to it. So if you said, this is the problem that I'm having, I keep closing my trades too early, I keep doing XYZ, here's all my data, here's my information, here's all my trades, voice call it. Okay, so what do I do? It will speak. Believe me, it's a game changer. It's a game changer. Anyway, back to this. So loss aversion. Imagine you have two toys. One toy is doing well, one toy is doing badly. For anybody who's just joined, we're explaining loss aversion as if we're 5. A good trader treats both toys fairly, but many traders do something silly. They let the bad toy stay around too long. They hold on to losing trades, hoping they magically get better, and they get rid of the good toy too fast. They close winning trades too early because they're scared of losing the little that they already made. I don't think that's the issue that you have. The issue that you have, or at least have on your record now, is holding the bad toy. So what does loss aversion measure? It tells us, does this trader behave the same with wins and losses, or are they scared of losses and doing silly things? It gives us a score 1 to 10, 0 to 10, which we already know. In kid terms, a good trader cleans up their mess quickly and celebrates their good moments. A bad trader ignores the mess and ruins their wins too early. Yeah, and loss aversion is just a score telling you which kind of kid or trader you are. So again, I know you're saying that you're going to make some changes and you're going to get rid of the grid or the martingale style things, but that's where it will trip you up, because if I'm an investor and I'm coming on to you know, your Darwin or your account to potentially invest capital, and bearing in mind a lot of our investors are our traders. There's a big crossover. There's a big overlap. I'm looking at this and I'm saying, well, again, this really concerns me because I don't want to be the one who's holding the bag if that happens again. So try and take this as a positive that you know it now. I mean, this was 2 months ago and you haven't done it as bad since, but try not to let that happen again. Don't hold the losses hoping that they will turn around, because it will hinder you significantly. I'm also just going to double check that the chat's working, just because this happened yesterday and all of a sudden chat stopped coming through. Is chat? There we go. Yeah, it's working. Document just published. Can see your latest message. Great. So we'll stick on here. We'll go through the stuff that you do well and the stuff that you currently aren't doing so well. So your experience is ranked 4.2 out of 10. That is simply because we just don't have enough data yet. The two things this measures is how many trades you take and over what period of time. So the more you trade, the more or the higher experience score you will have. That's not telling you to overtrade. That's just saying just stick at it for the next few months, and you'll see that score naturally increase. Market correlation. This measures your effectiveness of trading both sides of the market. Generally, for most traders, they have a score of above 8 or 8.5. The traders who struggle are ones who generally just trade one side. So either long only breakouts or trade long only stock and ETF portfolios. Of course, they might be able to hedge their exposure, hedge the performance of, let's say, the S&P 500 if that goes on a 10 or 15% drawdown, by being allocated to certain stocks instead or certain ETFs. They might be able to hedge that exposure. So actually, they don't perform as bad as the S&P. However, they're never going to perform as well as they would when in a bull market, right? So their market correlation score will probably be slightly lower. I was going to check somebody else then, but I don't want to dox their record. although I think they share it public anyway. Risk stability. Okay, so this is a big one. So you got a score of 0.4. This is purely based on that big trade, I believe. So you can see this happens where with martingale and grid strategies where you'll have, I don't want to say it's consistent because it's not the most consistent. Your VAR does have quite a big maximum and minimum value at risk compared to the monthly value at risk. But then as we come down, you can see as you're adding size, you can see how much your VAR spikes. So you go from 4.46 all the way up to 24.08 in literally a few days. Okay, so that's because of the amount of exposure that's getting added to that losing position. Now you've been pretty consistent. So the annoying thing here is from here to here, it's pretty consistent. But because your value at risk basically takes into account the previous 45 trading days and the previous 6 months to give you the average, you're still exposed to all of this. Okay, so you're coming out at the end of it now, which is a lot better. You're still slightly high. I would try and get that below 30%. So if you can bring that down slowly and not do it too fast, so that your let's call them the Bollinger Bands, so that your value at risk Bollinger Bands move with your average, so that you become under 30%. That would be phenomenal, because what we've seen over the past 13 years is that anybody who has a value at risk of over 30% has a significantly higher chance of blowing up their account. Not to say it's guaranteed, and not to say that it's not guaranteed if your value at risk is below 30%, but the chance of blowing it is exponentially higher when above 30. You reduce your lot size and reduce the grid. Yeah, good. I'd get rid of the grid completely if I was you, just because it will improve a lot of your metrics and scalability of the system. Risk adjustment 9.7 out of 10. That's quite strange, because I would have thought that the risk engine had intervened quite a bit, which it looks like it has to a degree. There's a trade here where the risk engine closed 80% of the position. It's the 9th of October, so I'm presuming that is the trade that caused the big loss aversion and the spike in your value at risk. So the risk engine closed out 80% of that trade, which is why grid and martingale doesn't work at Darwinex, because the risk engine will step in and close some of your exposure to protect investors. Regardless of that, you still got a very, very high score of 9.7. Open strategy and closed strategy. So these show on the same page. You've got a 4.5 and a 6.8 out of 10. Basically measures how well you open and close trades from a time perspective. What I mean by that is, would you benefit or would you make more money if you opened your trades X amount of time before or X amount of time after you do? And same with closing. Should you be holding trades for longer or holding trades for less period of time? The open strategy, the more I think about it, the more difficult it is to implement it. Because, for example, if you're trading breakouts, you can't, I mean, I guess you could say, you could wait for a breakout and then trade after the breakout. So, you know, if your average trade duration is 5 hours and it's telling you to enter 10% later, maybe you could wait for 50 minutes post breakout and then you trade. But if it's telling you that you'd make more money on breakout strategies by entering earlier, which is obviously the case, because generally, and I experienced this on XAQP. So let's say we have a trade like this, okay, and that's the breakout level, and you're trading it from there to there, okay. So that's what you're trading, and then you trade it up like that. Of course, you would have benefited by entering here. You'd have made way more money by entering anywhere there, right? But the trade logic isn't active until price crosses that. So it's very difficult to take, in my opinion. For breakout strategies anyway, it's very difficult to take anything from this, because you kind of need to wait for the logic before you go, oh, well, I'm just going to enter earlier, or I'm just going to enter after. You need the logic to be there. Closed strategy is a great one, because if you're going back to the, how are we doing, Gary? Hope you're all good. Going back to the issue with the loss aversion, and if you're closing trades too early or closing winning trades too early, this will tell you categorically if that's the case. So take your maximum favorable excursions and understand, okay, well, I usually hold trades for X percentage or X amount of pips, whereas they actually run for X more. Okay. And then if your close strategy also tells you that, you know, holding the trade for 10% longer, 20, 30, 40, 50% longer would also make you more money, you've kind of got no reason to be closing your trades early. It's only an emotional decision at that point because your data is all pointing to the fact. Whereas if you stayed in the market for longer, you would make more money, which I'm a big fan of. Like, for me, data crushes emotions. So if I'm feeling a certain way, for example, if I'm in a trade on XAQP and I'm looking at it and I'm like, this just doesn't look very nice, I'll always open it. I'll open up my strategy specifications and I'll look at the win rate. And I'm like, why am I enforcing my own bias on a chart that I'm not even trading? Like, I'm not even looking at the chart to make the trade. But why am I feeling this way if this strategy wins, you know, 77% of the time? Why am I so scared that it's going to lose if the strategy generally wins, you know, 70 plus, 77? You know, and so I'm a big fan of getting the data to back it up because, you know, it solves 90% of your emotional issues, in my opinion. We'll skip these ones. Oh God, tired today. I've still got to do some studying after the session. I'm about that far through now. Don't know if you can see that far through on unit 1. Hey, stop barking. So yeah, I'm trying to get an hour done a day, but it's a lot of work, especially at this time of night when I'm starting to slow down and get a bit more tired. Performance. So this is basically a Monte Carlo test comparing your strategy against 10,000 random strategies that are all operating with the same risk. You can see you're currently on the 97.76 percentile, which is fantastic. The thing I love about this is it kind of gives you instant feedback of how you're doing. So, you know, if you're having a crappy day, for example, we'll take a look at XAQP for a moment. So at the moment, like I said at the beginning of the session, I've had a pretty poor start to the week, and today feels like a pretty poor day as well. I'm in a few trades, but then if I come on here, if I come on to my performance chart, I see I'm in the 99.9th percentile out of 10,000 random strategies that are all using the same risk as XAQP. And I'm like, why are you being so hard on yourself? You're already outperforming all of these, all of the traders in, you know, DarwinIA who are after me in the ranking, but also in the randomness test in the Monte Carlo, you're also way above what you should be anyway. So it's kind of a bit, it brings you back to reality a little bit when, you know, you're being a little bit harsh on yourself, which historically I am quite a lot. But anyway, you're in the 97.76 percentile, which is fantastic. Capacity, 7.7 out of 10, which tells me you've got a decent capacity. So what we do to determine your capacity, which in other words is your alpha cap or your max investment, is we measure the toxicity flow of your orders. We then compare that with what an investor would experience if they were to invest X amount of AUM. So we look at how much slippage the investors would receive based on the AUM that they have. Based on the amount of slippage that the investor would receive, we would cut off the AUM at that level. So for example, if we know that an investor is going to be experiencing 0.2 pip slippage on every single position because of the size, trying to get the size into the market in one clip, we cut off your strategy, and that is your max capacity. So if we scroll down, you can see on here where it says capacity, max estimated investment, and then brackets Darwin, see your capacity is 61.75 million. I would highly anticipate this to continue moving lower till it finds its true capacity. Because when you're grid trading, you have something like this, where it's in the 170, 180 million range. Now you've slowed the grid down, you can see what's happened. It's just come down a lot. And that will happen because grid trading, it's very easy to implement size in that, because you'll be entering mainly smaller orders and you'll be spreading them over the market instead of, you know, full clipping 1,000 lots in one go. You might be spreading it into 10, 100 lot trades, for example, if you was trading with like serious size. So that's important to understand. But at 60 million, even I would say it's probably still going to come down a little bit, you know. But even at 40, 30 million, most traders won't get that far. That's just the honest truth, right? Some traders will, and it's not to say that you shouldn't aim for that. But there is a lot of capital out there. But you know, not every trader who's trading with, you know, who's on Twitter or Instagram, or not every trader at Darwinex is going to end up with 30, 40 or 50 million. It's just a matter of fact. So I'm generally happy with anything above 10. Above 10 million, I'll be like, okay, you can probably fill 10 million and, you know, like relatively easily through Darwinex, through private investment, working for, you know, subcontracting your systems out to external funds. 10 million, it isn't that difficult to raise. 50 million, a little bit harder. Can be done, but it's a little bit harder. But if your capacity is, like I say, 30, 40, 50 mil, I wouldn't be too concerned. Rob said mine is 5.46 million now. Come down lows. That's strange considering you're a swing trader. I think mine's about 26 at the moment. Where are I? Yeah, 27 million at the moment. Mine is SPWL. That's strange. Oh, what are you doing differently now? Have you increased your size? Stability. You've been increasing your size, haven't you? So again, something that I talk about a lot. I probably sound like a broken record. Your value at risk was about 2% here, 3% here, and it's currently 7%. Okay, or just under 7%. Now, people look at this and they say, oh, my value at risk has increased by 5%, but it hasn't really. So from 2% to 6%, okay, that is a 300% increase. 200% increase. 100% increase. Oh my God, my mental math. It's 200% increase. No, it's not. It's 300% increase because it's a 3x. So that is a 300% increase in your value at risk. Okay, which is huge, because that would equate to, you know, well, it wouldn't actually. I'm going to quit while I'm ahead. But essentially, that tells me that you're entering 3 times the size or thereabouts, which means your capacity will lower over time. And you'll see it more dramatically on that, because this is a small percentage. So again, 2 to 7%, you'll be like, oh, it's increased by 5%, but it actually hasn't. It's increased by far higher than that, like 350%. Same risk per trade. That's strange. Are you trading more markets? Are you like, there's a lot in there to unpack. Let's take a quick look. Advice for Darley, DAL, not Sarley, DALY. Oh, I've done it again. DALY. Oh, phenomenal! A year's record. Okay, 36.51%, max drawdown 8.55%. Fantastic. This, how long have you been in gold now? Yeah, I'm sure I've seen you. I've done something with your Darwin before. I can't remember whether it was post about it or include it in the newsletter or something. Neil Trades. Yeah, I've definitely seen this before. Number 8 in gold today. Fantastic. Okay, so the only thing that concerns me straight away is this drawdown here, purely because it's the steepest drawdown that you've had thus far. If we take a look, is it April 7th, 8.55, 8.21? Okay, so it's not the steepest drawdown. So you had a worse one in April, which I presume may have been equity-based drawdown, perhaps. I don't know. What's your April. Looks like it was this trade. Yeah, this dollar Swiss trade. It must have been that trade, and then it must have been this gold trade that is the second period of drawdown. Your value at risk is very, very high. Okay, your value at risk is very high. Again, going back to my point earlier, say 30%. What on earth is that? So the 30% level is probably somewhere around here, because this is a logarithmic chart, I believe. So let's say that's 30%. 30% value at risk. Above that, you have an exponentially higher chance of blowing your account at some point in the future. It's not to say it's guaranteed. It's not to say anybody trading underneath here won't blow their account, but it's saying that you have a much, much higher chance of blowing your account above there. The great thing is for you is since June to now, which is what, 6 months, you've been very, very stable. I would be looking for you to lower this down below that 30% level. Again, similar to what I was saying for BQPN, is trying to get that below 30%, doing it slowly over the next 3 months, because at almost 60%, you run a very, very high risk of blowing your account or going into a significant drawdown that's kind of unrecoverable from. It's not too concerning considering you're trading with Darwinex Zero, and it kind of is what it is. It's a virtual account, but for good practice, I try and get that below 30. Again, completely your decision, but that would be my main goal for you. Your record, however, is pretty impressive. I don't like this drawdown, I'll be honest, because it doesn't look like a series of bad trades. That looks like a series of over leveraging. You can sometimes tell a difference, and I could be wrong. Maybe you took a few big hits in a short space of time. Absolutely could be the case, but to me that looks more like an being over leveraged. The drawdowns look completely different. This to me, this section here looks like a series of bad trades. You haven't really got any more. This here, perhaps series of stagnating trades, bad trades. It's completely different to this. I'd say that, but it's not too bad. But it's completely different. So I'd be asking why this happened and how to avoid that again moving forward. Because again, when you're thinking about this from an investor's perspective, your record could be ticking along nicely again, but they know that there's a chance of this going to happen. I think it was 8% drawdown. Okay, so if I invest here and then it's straight into 8% drawdown, I'm like, okay, well, they know that there's that risk or that chance of that happening, and therefore they won't not invest, but there might be a bit more skepticism about the good periods, because they'll always feel like this is coming. It looks like it coincided with an investor pulling their funds as well. I would presume that you'll be considered for Darwinex Labs going into, if that wasn't Darwinex Labs already, you'll be considered for Darwinex Labs. You'll probably get a hedge investment as well soon. So your AUM will start to increase. Okay, there you go. There you go. Over leveraged myself on gold and it just tanked while I was away for a day. Yeah. That's kind of what I presumed. That's what it looks like. So just don't let that happen again, because the thing is, right, you have a fantastic record here, and this is like your CV as a trader now. You need to protect this like within an inch of your life. Okay, you're going to be getting a decent allocation at the end of the month if you can maintain this number. So just treat this as serious as you can, because I could be wrong here, and I don't want to step out of place with what I say, but this is your all-time high. Okay, so you was probably what, 30, 38, 39% perhaps. That looks like you get a bit cocky and then the market humbled you the next day, right? Because you tend to see off of all-time highs where the trader's kind of a little bit emphatic, and then they get that, and then it's like, oh shit, shouldn't have done that, and then they climb again. And it usually happens a few times, and then and then the trader learns their lesson and doesn't do it again moving forward. So that is the only blip. Other than that, it looks fantastic. I haven't got much time to go into the strategy entirely. Kingslayer Boozer 6662. Can you analyze my ticker? I'll have to do it in another session because I have to leave in 5 minutes or so because I've got to do some studying for my IMC, and then my kids will be back home. So as I always say, it turns into chaos. But I can do a private session, I can do a recording, or I can do it in the next live session as well. Like, that's absolutely fine. Just drop me, if you want me to do like a private analysis, just drop me a message on Discord or message our Twitter account or whatever platform you're watching on, and we can get something scheduled in, or I'll get a video or recording sent your way. If you'd rather me do it live, that's absolutely fine. Just turn up to one of the sessions next week and ping a message in. Try and be at the start, because if I get 3 or 4 people send messages in, I always struggle to get through them all. So try and be here as early as you can, and I'll be sure to get it done. Yeah, VAR is a double-edged sword. Yeah, I was at all-time high, and I thought, why not close this year around 50% ROI? Yeah, there we have it. Yeah, just I mean, use it as a lesson, right? Just learn from it. Like, everybody makes mistakes, no matter how far you are down the line. Everybody makes mistakes. The important thing is to note it and to not do it again. And the fact it comes off of an all-time high makes it even more, like, it stings even more, because you're like, oh, yesterday I was 7% higher, 5% higher, I was on top of the world, and now I'm like, it's an instant humbling that you get. And this is what frustrates me when I speak to a lot of traders, is that they get black and white proof that their strategy works. So you have black and white proof here. You go through stagnation, you black and white proof again. Okay, this is fantastic because you're at an all-time high after a period of drawdown. Black and white proof you can trade and that your strategy works. And then that happens, and it's like, why change what you do when you know it works? Yeah. So moving forward, again, everybody can afford to have a slip up. It happens, right? But moving forward, I will call you out on it if you let that happen again, because you can learn from this. And yeah, just moving forward, just don't let it slip, because clearly your edge works. Kingslayer, my Discord name is Trader Duff. No gaps, no thing is, let me show you. Down here, you see, it's Trader Duff. If you're in the Darwinex server, if you look on the right-hand side, you'll see 0 team. You'll see me here, Kieran Darwinex. That's probably the best way to find me, because, I mean, I did ban a load of fake accounts earlier today. Yeah, there's no more fake accounts in here, I don't think. Yeah, no more fake accounts in there. So there's only the me. I would find it by going in Discord and just taking a look at the top right, and you'll see me there. Thanks, Kieran, for your valuable guidance. Absolute pleasure, man. Absolute pleasure. And listen, you've got something special here. I think sometimes people don't realize it. Like, again, I speak to so many of our traders, and they don't realize that there's not many people who can do this. There's not many people who get to gold and can sustain a track record over a year, 2 years, 3 years. And so when you can, that is like a superpower to you. So treat it as such and be more protective of it, right? Because this can open doors to you inside and outside of Darwinex. Okay, believe me, there's people watching. Okay, and this can. How we doing, Tan? Hope you're all good. People are watching, and this will open doors, even if it takes a year or 2 years, and you have to treat it that way, as opposed to just treating it like a game. Not saying that you are, but I'm just saying in general, sort of thing. Global flows, how we doing, my friend? Hope you're all good. Have a general idea, but what can I do to improve my capacity, Jake? I'll ask another time if no time now. So capacity is a weird one, because there's no kind of one answer that will benefit everybody. What's your capacity now? 9 mil. Okay, so it's not awful, right? But you can definitely make some improvements. So the main idea, or at least what I always say is this is kind of common sense, right? There's a lot of things that you can change that is common sense. So trading more liquid assets. For example, if you're trading the FTSE 100, it's highly liquid. Well, not highly liquid, but it's a relatively thin market. If you're trading euro dollar, it's the most liquid market in the world. Of course, you're going to be able to execute more size on that. If you're trading with tight stops, if you're trying to execute with 2 or 3 pip stop, and then you try and do that with 10 million, you're gonna get smashed. Again, the logic behind some people don't subscribe to that notion because their mentor of, again, smart money concepts told them that a 2 or 3 pip stop is fine. But if you get slipped 1 pip on a 3 pip stop, that's an additional 33% cost on that trade. Whereas if you have 100 pip cost and you get slipped, if you have 100 pip stop loss and you get slipped by the same amount, so you get slipped by 1 pip, well, guess what? That's 100th of your trade cost. Okay, so it's like 100th additional cost. It's nothing. So trading with a wider stop, wider range, holding your trades for longer, staggering entries. So let's say you've got 10 lots to clip, staggering it. So it might be 1, 1, 1, 1, 1, 1 at various price points rather than 10 straight in. But yeah, it's kind of common sense score. The best thing that I would say to do, yeah, 3 pip is less. 3 pip or less is extremely hard to execute and rare. Yeah, there's not many people who do, there's not anybody who does that. Let's rephrase that. It's a complete BS approach. If you speak to any professional trader who trades outside of demo accounts, they will tell you that is just, you just can't do that. A whole trade for more than a week, is that good? Yeah, so that's good for your capacity because you're holding the trade, so like for an extended period of time. It doesn't mean that your capacity is going to be sky high because there's so many factors that go into it, but generally the less activity you have for that transaction, the better from a capacity perspective. But what I would do, and I think by now you probably all get that I do this a lot for myself, and I always encourage it. Give an LLM, whether it's Gemini, ChatGPT, Claude, whatever it is that you use, give it a full breakdown of your strategy. Give it your trades, give it your journal, give it your broker statements. Let it absorb and understand what you do. Then tell it what your capacity is, or what I really want to focus on improving this metric. I really want to focus on improving this part of my trading strategy. If you're using capacity, for example, go on the Darwinex K-Base, download the capacity page. So the capacity knowledge base page. So you've got all the text. Okay, give that to the LLM. Give it your strategy and say, act as, I don't know, a portfolio manager for a multi-billion-dollar hedge fund, and speak to me as such. And then tell it, like, ask it for tips and things that you can do to increase your capacity, because I can say X, Y, and Z, but it might not be relevant to you. Whereas when it looks, and I don't want your broker statements, A, it's a lot of work, and B, it's like very, very private. I mean, arguably, not everybody's going to want to put their broker statements into an LLM. I'm less bothered, but that's just me. But if it understands what I'm doing and what my end goal is, you're going to get. It's like, again, it's like having a superpower. That's what I would suggest to do. Okay, it's just extracting everything, giving it to an LLM, and saying, "This is my goal. How do I get there?" Anyway, guys, I'm going to call it an end to the session there because we are perfectly wrapping up at 5 p.m. My time. So like I say, I've got an hour of study now with good old investment environment training manual. So I'm going to go and do some work with that. And then my kids are home, and then it's time for me to switch off for the day. So I appreciate you all coming. I appreciate the comments as usual. I don't think I'll be on tomorrow, but we should be back on Monday for a session with Sanj. If not, I'll be on Tuesday for a normal session. So guys, I hope you all have a fantastic rest of your morning, afternoon, or evening, wherever you're watching this from in the world. Have a great rest of your week. Have a fantastic weekend, and I will see you all next week. Peace out, guys.